Getting tired of higher interest rates chasing stubborn inflation, of governments offering more of the same, and of a war with much more at stake than just money or politics. This is Bloomberg Wall Street Week. I'm David Weston. This week, our contributors Larry Summers on the Fed Decision Day Wednesday, followed by the jobs numbers on Friday.
The good news is economy looking robust. The bad news is not much evidence of inflation restraint yet in train.
And Steve Rattner on what's at stake for investors as Americans go to the polls in the midterm elections.
I think elections are hugely consequential for investors because there's a lot at stake here.
This week, it sometimes felt like it was more of the same, starting with the next phase of Russia's war in Ukraine, which saw Russia target civilian facilities, as explained by John Kirby of the National Security Council.
We know that this is yet another wave here. Airstrikes, a lot of missiles fired at, in particular, the capital, fired at both power and water facilities.
Even as the First Lady of Ukraine, Olena Zelenska, told the world just how hard it is really for the Ukrainians.
Nobody can imagine how tired Ukrainians are. The threat is not just Ukrainian for Ukraine. For us, the fatigue means that we will perish.
Meanwhile, the rest of the world continued to wrestle with the effects of the war, including higher energy prices, with President Biden promising to take action and blaming the problem, at least in part, on the oil companies.
Record profits today are not because they're doing something new or innovative. Their profits are a windfall of war.
In Brazil and in Israel, new elections yielded old results, with former President Lula da Silva narrowly winning re-election to the presidency.
We've been covering the Brazil election. Of course, it's a historic narrow victory of Luiz Inácio Lula da Silva, the former president.
And Benjamin Netanyahu heading to a fifth stint as Prime Minister of Israel.
In Israel, the fifth election in 4 years appears ready to return Benjamin Netanyahu to power.
But the main events for Global Wall Street this week came from the central banks. First and foremost from the Federal Reserve, which on Wednesday did as expected and raised interest rates another 75 basis points, with more to come, according to Chair Jay Powell.
We still have some ways to go. And incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected.
While the Bank of England came in with its biggest increase in more than 3 decades Thursday, and Governor Andrew Bailey warned about what could happen if they don't take steps now.
If we do not act forcefully now, it will be worse later on. And as the forecast we are publishing today shows, it is a tough road ahead.
And then we ended the week with U.S. jobs numbers, which came in higher than expected, adding another 261,000 jobs, with wages going up another 0.4% over the month of September, which could have sent markets into a tizzy, but didn't, as equities had already taken a hit from what Chair Powell had to say back on Wednesday. For the week overall, the S&P 500 gave up 3.35%, the NASDAQ was off 5.65%, and the yield on the 10-year was up about 16 basis points, ending the week at 4.16%. To take us through the week in the markets, we welcome now Sharmin Mossavar-Rahmani, Goldman Sachs Chief Investment Officer for Wealth Management, and Sarah Ketterer, co-founder and CEO of Causeway Capital. So welcome both of you back to Wall Street Week. Good to have you here. Let me start with you, Sarah, if I may. So what's an investor to do with what they saw this week? A lot of turmoil.
No doubt about it, David. And strong payroll data makes the Fed job much more difficult. This labor supply shortage situation is quite concerning. So it looks as if the Fed is going to have to continue raising rates. And this creates a tremendous headwind for the U.S. market and for markets around the world, where central banks have to move up. If not in lockstep with the Fed, they too have to be tightening in order to quell inflation that is global.
Sharmin, I wonder, did Jay Powell get us ready for this to some extent? I'm assuming he didn't have any idea what the numbers were going to look like, but he sort of warned us on Wednesday what they were going to have to do.
When we think of this number, though, I don't think we have as pessimistic a view and as pessimistic a read. In fact, you could see what happened to the market today at the end of the day. And you could say, in fact, the market's probably saying it's not as bad a number from a tightening and a recession perspective. So in fact, our view is that if you look at the non-farm payroll numbers at the beginning of the year, they were averaging over 3 months about 600. The last 3 months now are about 290,000. So that's nearly more than half. So that's a significant slowdown in the economy that we're seeing. And then if you look at the average hourly earnings, and you look at what the latest 3 numbers are, about 3.9%. The prior 3 months, it was 5.2. So directionally, between what the Fed has been doing and generally financial conditions in the United States, things are slowing down, and it's not insignificant. So the question is, how much does the Fed need to tighten to lower those numbers even further? And our view is that they do have more to go, but I'm not sure the idea that it's definitive, they have to go to 5% or 5.25%, it's not so obvious to us.
At the same time, are the markets fully discounting, Sharmin, you think, what the Fed is going to have to do? Because as you say, they're going to have to do a lot more, as Jay Powell said he was, but do the markets get that?
Obviously, I think the markets, if you look at the pricing on the 10-year, if you look at what's happening in the short end of the curve, and if you look at the market volatility that we're seeing in the equity market, we do think the markets do understand the uncertainty of that. We actually encourage our clients to think about the recession probabilities with a very open mind. We have 2 incredible economists, great experience. One is Bill Dudley, former partner at Goldman Sachs, our chief economist, and he became head of the Federal Reserve Bank of New York and vice chair of the FOMC. He has a 70% probability of recession. And then you look at Jan Hatzius, our current partner and chief economist, and he has 35%. So that tells you that we should think about recession as a 50-50 probability. We may have a recession, we may not, and our view is the market is priced to that the market is already saying the odds of a recession are very high.
What about it, Sarah? Is the market discounting already a fair amount of a recession? I mean, actually, some of the numbers suggest that, if not all of it, a fair amount of it is already priced in.
That's very tough to say, David. What we do know is the lagged effects, as the Fed has pointed out, are economy-wide. In fact, they're global. And more companies we speak to are talking about sales are holding up. They have some serious cost pressures. But they're just seeing this beginning of demand starting to turn down across industries. So it looks to us like it's early days for what may be happening to earnings. And it's only when earnings bottom do markets begin to really anticipate the recovery. If earnings continue to be revised downward, we're in for a pretty tough period. And the higher interest rates go, clearly the more pressure, downward pressure on earnings multiples, which again is not helpful from an investment perspective.
Sharmin, what is your view actually on where we are compared to, for example, emerging markets or compared to China? Is our market already discounted more?
Our view is that the equity market has actually discounted a lot. If you go back and look at past recessions, on average, the median, and we look at the median because you don't want, for example, really extreme numbers to be pulling down the market. So if you look at the median, on average, it's down about 24%. Then you look at the average numbers, it's around 30%. And high to low, the S&P 500 has actually been down about 25%. So to say it's not discounting a recession seems a little bit of a stretch to us. Our view is it has already discounted a bit of a recession. And then the next question becomes, if we do have a recession, how much further can it go? Could it be down another 5 to 10%? Yes, but we do think a fair amount has already been discounted. The other thing to keep in mind is the equity market usually actually rallies before the trough in earnings, usually by about 6+ months. So we don't actually have to see the big downdraft.
So, Sarah, is it time to go back into bonds?
I wouldn't if we think rates are going to continue to rise, but we're really equity specialists. And if it's interesting what Sharmin has to say about markets in aggregate, but start to disaggregate. And there's a fascinating push and pull now globally, and particularly in the U.S., between what's happening in the more defensive sectors. Let's take energy aside, but those that are less economically sensitive versus those that are very economically sensitive. And we think one of the biggest decisions that investors are going to need to make over the next 12 to 18 months is when to make that shift. And the only one way to think about this is just start now and do it very gradually, because we just don't know where we could talk about it all day long, but we have no idea where markets will actually bottom. But out of recession or out of economic slowing, the best performers typically are the more cyclical stocks or those cyclical sectors. And it's getting from the defensives to the cyclicals. That is the critical journey in this market.
Sarah, one of the things we have found is that when you've had a big downdraft in the market, for example, if equities are down 20%, usually the next 12 months, on average, equities are up about 23%. And if you look forward 2 years, equities are actually up over 30%. Now, this is the S&P broadly, and obviously when you look at the sector dispersion, it's been quite significant this year. As you point out, energy is up 70%. You look at sort of technology and other sectors down 20, 30%. So clearly huge dispersion. But in aggregate, the equity market tends to rally after such a big downdraft. So does it make sense actually for investors to start getting more aggressive with their portfolios?
Well, this is really hard to say, not knowing investors' risk tolerances. But to my point earlier, again, we can't know the bottom. It's true of us as equity analysts and portfolio managers. We never know where a stock's going to bottom, and therefore we accumulate early. And then we get quite a bit of as much of the stock as we can, as low as we can, and the average entry price is usually very attractive, and that creates a lot of room to make money on the way up. And I think that same analogy applies to broad markets. So there are ways of working to getting access to different markets around the world, especially emerging, that are absolutely on their backs relative to developed. But they're all at multiples now that are beginning to look more attractive, as long as earnings don't collapse, and that's the big if.
Okay, Sharmin Mossavar-Rahmani of Goldman Sachs and Sarah Ketterer of Causeway Capital will be staying with us as we focus on some investments outside the United States and what we expect from China, emerging markets, and Europe. This is Wall Street Week on Bloomberg.
Wall Street really loves ambiguity. Because the truth is that while the midterm election results scarcely constituted a warm vote of confidence in President Reagan's economic program, they were far from the Democratic landslide that some pre-election forecasters were predicting. Indeed, the actual result, Republicans holding the Senate and losing 26 seats in the House, was remarkably close to the figures I gave on this program last week.
That was Louis Hochheiser, of course, on Wall Street Week after another midterm election 2 years into a new president. That president was President Reagan, and it was 1982, when it didn't come out quite as badly as Republicans had feared, something that Democrats this year are hoping for. The top movie back then was First Blood, starring Sylvester Stallone as Vietnam vet John Rambo. The #1 song was Up Where We Belong by Joe Cocker and Jennifer Warren. Still with us are Sarah Ketterer of Causeway Capital and Sharmin Mossavar-Rahmani of Goldman Sachs. So, Sharmin, maybe some parallels with 1982, but one thing that's very different is there wasn't a lot of U.S. investment in China back in 1982. Flash forward to today. Where are you on China? We've just come through that 20th National Congress.
In general, we've had a very strong U.S. preeminence view, recommending clients have a significant overweight to U.S. equities and, in turn, a significant underweight to emerging markets, which includes China. If you actually go back and look at the returns from the trough of the global financial crisis to the present, you will see that U.S. equities are up about 16% on an annualized basis and 5% in China on an annualized basis. But actually, one needs to look at the impact of that compounding. As this chart that you just put up, if you had had $100 and put it in U.S. equities today, you'd have $750. If you had put it in China, $188. Not even a quarter of those returns. Now, that has prompted some people to say, well, that actually means China is very attractive. We actually think that China is not attractive. China's growth will be much slower than people expect going forward. China has overinvested in property, in infrastructure. They have a major demographic problem. So when we actually look at it on a forward basis, we think the earnings will not be there to even support these valuations.
Oh, just have to jump in. There's so much truth in that about China. It's just so interesting to see, though, that much of the big sell-off started in just 2021, last year. China is currently 30% roughly of the emerging market benchmark. So it's really important. And it has both buoyed up the benchmark and dragged it down. But there's China and Taiwan together are some 45% of the index. You sort of can't get away from China if you want to invest in emerging markets. And one way or another, their growth rates have tended to be faster than the US in the past. And to your point, Sharmin, they are slowing. But the opportunities there, because it's just such an enormous market, are really hard to pass up. I think the property sector is horrible. And what place had the worst property wipeout we can think of? In the late 80s, it was Japan. And yet there was still money to be made in that what ended up being rather a stagnating situation if stock selection was good. So we're never writing off China. But what's irresistible about emerging markets, again, with China as the anchor tenant, is that it's trading at this 20-year low in price to book value. And then on a price to earnings basis, it's also at this extraordinary bouncing along its 20-year low versus the US market and the world index. So at some point in time, you have to say the price is right for emerging markets led by China.
There's no doubt about that, Sarah. But when we actually look at the price, we think you need to think about the sector weights. So emerging markets in general, and that applies to China as well, have a very different mix in terms of the sector exposure relative to the US. So on the surface, when you're looking at the discount to China or emerging markets or even developed markets relative to the US, it looks like it's very low. But on the other hand, if you adjust for the sector weights, meaning, for example, technology is 25% of the S&P 500 and less in China, less in emerging markets, and maybe even less than half in developed markets. If you adjust the sector weights, then these countries and regions are not as cheap as it appears. In fact, suddenly emerging markets, instead of being, for example, let's say a multiple of 16 for the US versus 10 for emerging markets, once you adjust the weights, it's more like 14.5 times forward earnings. So in fact, if you adjust the sector weight, then we don't think these markets look at as cheap. And historically, that discount has not always been an indicator of good forward returns. But Sarah, you mentioned a very important point, which is stock selection. It doesn't mean that stock selection can't add value, but when we look at the countries in aggregate and broadly at sectors, we just don't find them attractive at all.
Yeah, that's a very good point about sectors. And I'd argue this, think about it in terms of value versus growth. The growth part of the emerging market benchmark does still look pricey. But if you strip out the stocks that are in that lower valuation group, they're at lows that we haven't seen in a long time. They're very, very compelling. And you can find those across sectors, which is pretty useful. But ultimately for China, the catalyst, what will make China much more interesting is just a recovery. And if it turns out, the head of our China office in Shanghai tells us next March is likely the date at which the gradual reopening becomes less gradual to the point where it's so obvious that they can't be denied by the party leaders. That will create an economic tailwind for China, even with a very tough property market. And it could, interestingly, coincide with what is still slowing in the rest of the world, making China look relatively attractive.
So, Sarah, I suspect we're all looking for bargains and trying to avoid falling knives, right? Whether it's China or somewhere else. Talk about Europe. Are there bargains in Europe at this point, or is that a falling knife?
Well, it fell with the Russia invasion of Ukraine in February. Europe was just awful, and it continued to be awful. And the cyclical part of Europe, any type of manufacturing, any users of natural gas were sold off heavily by markets, materials within that, chemicals. So many stocks trading at discounts to book value that indicated apocalypse. So yes, bargains in Europe, and they're still there. Some of those stocks have improved, but to the degree there isn't a harsh winter and Europe doesn't consume all of its energy, its gas storage reserves, which we think it won't, it looks as if Europe can squeak through this winter and perhaps even next. Meanwhile, there's a feverish effort there to build LNG terminals and ensure that there's a regasification capability. This all takes time, but Europe is united around their concern of having been dependent on Russian energy, in particular natural gas, and their determination, fierce determination to be independent from that. And that itself is turning out to be useful because we needed to see, especially within the Eurozone, some type of fiscal unity, and they're getting closer to that. So it's not, Europe isn't a great place to be other than as a tourist, but it certainly looks, from an investment perspective, attractive.
So, Sharmin, let me ask you this as a chief investment officer. How do you discount geopolitical risk? Because obviously the war in Ukraine is awful. It looks like it's going to go on forever, but it may not. How do you discount the possibility, if something happened and it went away tomorrow, it would change the valuations dramatically? Do you take that into account at all?
We pay a lot of attention to geopolitical risk to try and figure out what has or hasn't been discounted. And obviously, it's very hard to know at any point in time what the market has discounted. But both in terms of China and in terms of Russia, we think the geopolitical risks are significant and we cannot anticipate them. So do we know if there's further escalation, would Russia use some kind of a dirty bomb? What else will they do? Will they attack infrastructure? Will they increase cyber attacks? So definitely something to worry about.
Investors don't like uncertainty. Thank you so much to Sharmin Mossavar-Rahmani of Goldman Sachs and also Sarah Ketterer of Causeway Capital. Coming up, we'll take a look at what's coming up next week on Wall Street, Week on Bloomberg. This is Wall Street Week. I'm David Weston. It's time now to take a look ahead at next week on Global Wall Street, starting with Juliet Sally in Singapore.
Thanks, David. The week ahead will likely confirm a deepening slowdown in China when the monthly activity data is released. There was a week-long holiday in October, but still export growth is expected to weaken, and Bloomberg Economics expects factory prices to drop for the first time since late 2020, while consumer inflation is likely to soften further. On the flip side, GDP readings from Indonesia, Malaysia and the Philippines are likely to show Southeast Asia's growth is holding up.
Climate change is very much in focus this week as the COP27 conference gets fully underway in Sharm el-Sheikh. With inflation and rising energy prices center stage, the summit in Egypt will seek to hold political leaders to their carbon reduction commitments. And after the previous week, we got the Bank of England's latest rate hike. We're going to get an update on UK GDP on Friday with a first reading for the third quarter. And the fifth and final season of The Crown will be released by Netflix on Wednesday. This time, the company has added a disclaimer to its marketing for the series about the royal family, saying the show is a, quote, fictional dramatization inspired by real-life events.
With the Fed meeting out of the way, markets will focus on two key economic data points in the week ahead: consumer credit and consumer inflation. Credit card balances are projected to have jumped by $33 billion in September. That would be about triple the average monthly advance over the past decade. Later in the week, we get the Consumer Price Index report, which has posted a headline reading of 8% or more for 7 straight months through September. Finally, Tuesday is Election Day, a pivotal midterm vote that will determine control of the House and the Senate, a shifting of political power with major implications for tax, fiscal, and economic policies. David?
Thanks to Juliet Sally, Danny Berger, and Romaine Bostic. Coming up, control of the U.S. Congress may be up for grabs at the midterm elections on Tuesday, but what is at stake for investors? We ask Steve Rattner of Willett Advisors. That's next on Wall Street Week. Tuesday's the day for Americans to decide who will be in charge up on Capitol Hill for the next 2 years, with expectations for the Republicans to retake control of the House.
Republicans have a lot of optimism going into the election.
And the Senate pretty much a toss-up.
No one knows exactly what's going to happen with the Senate, with races just too close to call.
But as much time and attention as we're paying to the midterms, what real difference will the outcomes make for global Wall Street? Republicans like Kevin Brady claim they will make sure less money goes to the government, which will benefit business.
You'll see a push for less government spending, less taxes, and less regulation to drive up inflation. You'll see a push for more American-made energy.
While Democrats claim that it's all about fairness.
They're going to shut down the government by not providing the votes to pay our federal debt. This is irresponsible.
But some who follow it closely, like Libby Cantrell of PIMCO, question how much will really change one way or the other.
Is the practical differences between Republicans taking back just the House and taking back both the House and the Senate are really de minimis.
And to give us some answers to what difference the midterm elections might make for real investors, we now welcome somebody who is putting real money to work. He's Steve Rattner. He is chairman and CEO of Willett Advisors. They invest the personal and philanthropic assets of Michael R. Bloomberg, of course, the man who founded our company and still owns most of the shares. So welcome, Steve. It's great to have you back on Wall Street Week. So you've had experience in Washington as well as in New York on Wall Street. We spend a lot of time, people get paid a lot of money trying to analyze these elections about what they will mean for investors. What's your experience?
I think elections are hugely consequential for investors because there's a lot at stake here. Take, for example, tax policy. If you want lower taxes for wealthy people in business, then obviously there's one team that you want to vote for. If you want lower taxes for working people and people below, then it's another team you want to vote for. There's all kinds of policy decisions. We've seen an enormous amount of legislative activity these last 2 years, particularly this year, and that's the kind of thing that happens after an election.
So, as you say, we've had a lot of legislation through Congress, since the last Congress, and particularly given the fact that it was really evenly divided in Congress. So looking back, before we look forward, do you think overall that was good for investors, not so good?
I'm not sure it was great for investors, but a lot of it was stuff that we really needed to do for the sake of our economy, particularly the climate change. I don't think we should kid ourselves. Addressing climate change is going to be expensive for companies and therefore for investors, but we have to do it. Prescription drug costs, we have to get under control. So I think from an investor's point of view, some of this may cost them some money, but I think there were things that had to be done for society as a whole.
Looking forward to the midterms, we don't know what the results will be, obviously, but some people are projecting we could have a switch in the majority in either the House or the Senate, or even conceivably in both. If you get a divided government, which is what that would be essentially, is that potentially good for investors simply because they won't do very much at all? They can't get much done, and there's some stability.
Yes, I think you're right. If we have divided government, it's highly unlikely, particularly in the run-up to another presidential, that we're going to get much done. Look, it depends what you think the alternative is. If you think the alternative was a Congress and a White House controlled by people who essentially wanted to make investors happy, then obviously that's not as good, and vice versa. I happen to personally believe we still have huge problems in this country that we need to address, long-term structural problems like the debt and the deficit, for example. And having government frozen is not really the way it's supposed to work. You're supposed to be able to legislate every year, not just every year out of 1 year out of four or something like that.
You oversee the investment of a lot of money, and not necessarily investing it yourself, but really overseeing people who do that. In the course of doing that, do you take into account which industries, which companies might do better under a Republican administration rather than a Democratic one?
Sure. You can easily see, and as you point out, most of our money is invested through other managers who do actual stock picking and so forth. But we spend a lot of time meeting with them, as you would imagine. And yes, absolutely, they think a lot about what might happen in Washington, how that would affect the investability, to use a word that might not be a word, of different sectors, different industries, different companies. So sure, what goes on in Washington, I don't think any investor would tell you that what goes on in Washington isn't incredibly consequential for the economy, and therefore we all pay a lot of attention to it.
This week we had the Federal Reserve come out, raise interest rates another 75 basis points. If you can compare and contrast Fed decisions on where we are on the 10-year yield, for example, versus who is in charge of Congress, which is more consequential potentially for investors?
Well, I personally think the Fed is the biggest game in town in terms of affecting the economy. I'm not quite a Milton Friedman monetarist, but I believe enough in the power of monetary policy to believe that it is the biggest thing that affects the economy. And by the way, it probably affects the stock market even more directly in a sense. When interest rates go up, it's the enemy of stock prices. They tend to go down. You've seen that happen this year, and vice versa during 2020-21 when the Fed poured all that liquidity into the market went up. The old saying, don't fight the Fed. So I watch the Fed very closely, and I think it is far more of an influence on the economy than Congress.
So higher interest rates are the enemy, as you say, of the stock market in the short term. But doesn't inflation have something to do with the value of investments as well? If in fact, particularly when you talk about bonds, but other investments as well, if you've got inflation that really isn't under control, doesn't that affect your investments?
It might, but inflation is actually good for some investments. It's good for what we call real assets, things like real estate, commodities, and things like that. It really depends, I think, a lot on what accompanies that inflation. If you happen to still be in a high growth or reasonably growing economy and you get some inflation, that can actually be a positive. If you get stagflation or you get high inflation and a recession like what we had in the late 70s, early 80s, then obviously that's bad for investors. So nobody likes inflation. It's destabilizing the business. It's destabilizing to American families. But, and therefore, it's not something investors want, but it's not necessarily the end of the world for investors.
You talked about tax policy, and you also talked about the Fed and what happens with interest rates. What about regulatory policy?
Well, I could almost argue the opposite in a way, that you may see more activity by the regulators because they might feel like the clock is running out on their term in office or whatever, and they might want to get stuff done. I've been a little surprised in that I would expect a very robust regulatory environment out of this administration. They've appointed people to many of the top regulatory positions who are very much pro-regulation, and you can see it starting to happen at the SEC and places like that. So I do think you're going to see a lot of regulatory activity over the next 2 years, regardless of what happens in the election.
One of the things that this administration has said they really want to go after, if I can put it that way, private equity, using things like Clayton Act Section 8 on interlocking directors, things like that. They think that there's some antitrust things going on there. Is there a chilling effect on private equity right now because they also have other things that are headwinds for them?
Well, the biggest headwind for private equity at the moment is the fact that in an environment like this, deals tend to slow down or even stop. And you can see if you look at the overall M&A volumes, how much slower it is now than it was, because the sellers all want yesterday's prices, the buyers want to pay today or tomorrow's prices, so you have a disconnect there. I think the problem in general with mergers over the last really 20 years or more has been a pretty benign antitrust environment. And when I was in the M&A business, clients would come in and immediately they wanted to talk about which of their competitors they could buy. And that game, I think, in this environment is starting to wear out, and so that relates a bit to private equity in terms of their portfolio companies. But I don't think private equity in and of itself is an antitrust problem.
It's not as easy to raise money these days. It's more expensive. You can find it. Some people have trouble finding it, period. Does that mean that private credit is stepping up to that? Is more and more the funding coming from private credit?
You're going to see that happen. First of all, there's just less credit, and there's going to be less credit, fewer deals, fewer acquisitions, less credit. But yes, the banks have, I wouldn't say gone out of business, but the banks have become very leery about lending. The high-yield debt market is effectively closed, and so in fact you are exactly seeing that, private credit stepping into the breach, which is attractive for investors because often you can get low double-digit kinds of yields or returns on that. Obviously not as attractive for the borrower who was paying a few hundred basis points not that long ago.
Is it attractive for financial stability? Because coming out of the 2008 crisis, we had a lot of regulation of the banks. We sort of know, I think, what's going on there by and large. A lot of money went into private credit. I'm not sure that's as transparent to regulators.
No, and that's a broader problem that we've had really since 2008 or 9, which is that the more you regulate parts of the financial system, the money tends to flow to the unregulated parts of the financial system. Having all that credit going on outside of the regulated part of the economy is not ideal.
One last question, this is asking you to be a soothsayer, which is tricky. We saw what happened with the UK pension funds when that mini budget came out. It was not good. But one wouldn't have thought that pension funds were leveraged highly, and yet it turns out through some derivatives they were. Do you see any indications of other parts in the marketplace where you might not even expect leverage at all, but as the interest rates go up, it really puts pressure on some investors?
That's a great question. The UK, is my understanding, that whole pension thing was a very unusual policy move that they did. I don't know that it's replicated here, and obviously the point is that the UK didn't know it was a problem until it became a problem. And so I don't think you know about these problems until they really appear. So I don't have anything off the top of my head in terms of things that I worry about. But a lack of liquidity, rising interest rates does put strain on the financial system, and then something will pop loose.
Steve, so great to have you back on Wall Street. Thank you so much.
much.
That's Steve Rattner. He is Chairman and CEO of Willett Advisors. Coming up, we'll wrap up the week with special contributor Larry Summers of Harvard. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. We're joined once again by our very special contributor on Wall Street Week. He is Larry Summers of Harvard. So, Larry, welcome back. We had a lot of economic news this week. We had jobs numbers and we had Fed results, of course. Let's start with the jobs numbers because they came in, I think, at least relatively strong. How did you interpret them?
I saw it the same way. Look, the population only grows by about 50,000 adults a month. So anytime you have 250,000 jobs, you're growing at a rate that you're not going to be ultimately able to sustain. It shows that still the economy is looking quite strong, no recession soon. You saw wages tick up. So the good news is economy looking robust. The bad news is not much evidence of inflation restraint yet in train.
Of course, when Jay Powell, the chairman of the Federal Reserve, spoke earlier on Wednesday, he didn't know what those jobs numbers were being, I don't believe. At the same time, what he said anticipated just what you just said, is that inflation continues, they're going to have to keep hiking. I assume you thought what they did made sense.
Yeah, I think there was a little bit of bouncing around immediately after the statement, but after Chairman Powell's press conference, I thought the necessary and right signal has been sent that the Fed is determined to stay the course with respect to inflation, that a sensible judgment of where the terminal rate, how high Fed funds will ultimately have to go, has gone up given the strong inflation numbers, the strong employment numbers that we've seen, and that the Fed is determined. So I thought those were very much the right kind of signals for the Fed to send, and I think it's appropriate. I think we are starting to get some little suggestion in the data. We don't know yet, and we always have to remember about lags, that the effect of interest rates on slowing the economy might in toto be somewhat less than many people supposed. And if that's right, I think it's going to be pressure for interest rates to be pushed up further in order to get done the necessary inflation restriction. So I'm moving upwards my view on the possibilities for the terminal rate. It's not what I would expect, but it would not surprise me if the terminal rate reached 6 or more. And I think the Fed has to be noticing that there's been started to be some upwards moves in inflation expectations, albeit from low levels. And that's got to be a source of concern for them as well.
Larry, we're also beginning to get some suggestions, including even by some economists like Mark Zandi, that in fact the real cause of the inflation is more a matter of supply rather than demand. And because of that, it's not going to be really effective to just try to curtail demand through increased rates. And therefore, by beginning of next year, maybe they should start cutting back. What do you make of that suggestion?
I have to respectfully say that I can't really see a lot of logic in the views that Zandi and those like him are expressing. Look, the basic fact is that the way you tell a supply shock from a demand shock, both of them raise prices, but when there's a supply shock, quantity falls. When there's a demand shock, output is strong, and output has been very strong. Employment has been very strong. the people who talk about supply shocks, it's really just the last readout of Team Transitory. First, it was a story about COVID ending quickly. Then it was a story about COVID ending slowly. It keeps bouncing around what the story is. We've still got high core inflation, and gasoline prices were mostly down for a period of more than 3 months. So I don't hear the story. Very simple ways of looking at the data. Look at what's happening to nominal GDP, total dollar volume of GDP. If that's going up rapidly, that tells you that demand is going up strongly.
Larry, another issue that it's rearing its head, you've seen this issue before, and that's the debt ceiling up in Congress, because we're going to be pushing up against it sometime in the new year, maybe not even too far to the new year. We're now seeing some talk on Capitol Hill that perhaps, particularly Republicans, if they come into power, will actually hold that hostage to get some other changes they want, particularly in things like entitlements. What's your experience with the debt ceiling? What should we be doing?
There are a lot of bad ideas in American politics, but I think it's close to the worst idea in American politics that we should hold hostage the creditworthiness of the country, threatening to default for the first time in 250 years. And the ransom that people want is taking Social Security benefits away from retirees, not a single one of whom gets more than $40,000 from Social Security. It is almost impossible to see a worse idea, either in terms of the hostage taking or the desired ransom. The right thing to do is for us to raise that debt ceiling for a long time so it won't be a political football. And I hope that as many responsible Americans as possible can say, look, yes, I am for entitlement reform. I am for looking at the long-run deficit picture, but hostage taking to cut Social Security is wrong. And I hope some of the business leaders who watch this show, whose PACs are giving money to support the people who are advocating that, will convey that as responsible financial leaders, they know that their companies and all our fellow citizens have a stake in the United States not playing games of chicken with our country's creditworthiness.
One more here, an important argument in the Supreme Court this week on affirmative action. You've dealt with that not just as an economist, but also as president of Harvard. What is the role of affirmative action in the United States within the economy?
Look, I was pleased to sign the brief that was provided on the basis of many universities the last time affirmative action was in the Supreme Court. And fortunately, at that time, affirmative action was upheld. Who knows what will happen this time. But I'll tell you, David, I think what's most profoundly important for fairness in our country is not the admissions policies of a few dozen elite institutions. What's most important is the achievement and the achievement of our minority citizens, and the educational achievement statistics that have come in from COVID are catastrophic. They represent a 25-year fallback in progress we had been making at a time when a math-smart, analytics-smart workforce has never been more important to compete with China. And this ought to be our national preoccupation, to make sure that every kid learns everything that they can. And, you know, more people are talking about the latest poll than are talking about these test results that are really showing millions of kids are being left badly behind in an age that's all about knowledge.
Yeah, so terribly important. Thank you so much. That's Larry Summers, our very special contributor here on Wall Street Week. He is, of course, from Harvard University. Coming up, if at first you don't succeed, well, we'll take a look at two world leaders trying again this week. That's next on Wall Street Week on Bloomberg. Finally, one more thought. Second acts. They're what most of us hope for, but F. Scott Fitzgerald once thought Americans may not get. History is full of people who were counted out and came back, sometimes even stronger than ever, like Richard Nixon losing to JFK in 1960 and coming back to take the presidency, go to China, and win re-election by the second largest margin ever, though it did end rather badly with that whole Watergate thing.
I shall leave this office with regret at not completing my term, but with gratitude for the privilege of serving as your president.
And Steve Jobs, driven from the company he founded, only to return when Apple was at death's door.
Apple needs to find where it is still incredibly relevant and focus on those areas. Apple has neglected its core assets for a while.
And take it to greater things than anyone could have imagined, revolutionizing the way we communicate and live our lives.
These are not three separate devices. This is one device. And we are calling it iPhone.
Or Michael Jordan, who retired after winning 3 NBA championships, went to play baseball, sort of, and then returned to the Bulls to three-peat yet again.
There is a reason you call somebody the Michael Jordan of. He is the definition of somebody so good at what they do.
But those are the second acts that worked. There are others that didn't go so well, like Teddy Roosevelt, who wanted his second act so badly that he turned on his own Republican Party when it refused to nominate him, created the ill-fated Bull Moose Party, and succeeded only in putting Democrat Woodrow Wilson in the White House. Or Tiger Woods, arguably the greatest golfer of all time, who crashed and burned figuratively and then literally, and valiantly tried to come back and play through the pain, which we all watched with sympathy and, yes, a bit of regret.
My body certainly can get better, but realistically, not a whole lot. At 46, you don't quite heal as well as you do at 26.
This week, we got our fair share of new second acts to watch, with Luiz Inácio Lula da Silva becoming the once and future president of Brazil, narrowly beating out the current president, Jair Bolsonaro.
Brazilian President Jair Bolsonaro has broken his silence on his election loss, promising to respect the constitution, but still stopping short of formally conceding.
And talk about a comeback. Less than 3 years ago, Lula was in a Brazilian prison on money laundering charges, released only when a higher court ruled that the original sentencing court didn't have jurisdiction to convict him in the first place. And then there's the biggest comeback kid of them all, Bibi Netanyahu over in Israel, poised to come back for a 5th time as prime minister, ducking and weaving and moving ever further toward the religious right, but doing whatever it takes to survive.
Former Israeli Prime Minister Benjamin Netanyahu looks poised to return to power after the 5th election since 2019.
Time will tell whether the second acts of Messrs. Lula da Silva and Netanyahu look more like Tiger Woods or like Steve Jobs.
A lot of times people think they're crazy, but in that craziness we see genius.
That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.